Welcome to breaking news, to trading moves. Welcome to the debate. Usually, when we talk about a medical diagnosis, there's an expectation of precision.
Right, like engineering.
Exactly. You break your arm, the x-ray shows a jagged white line, and the doctor just points and says, well, there it is.
Yeah, broken or not broken, we like things to be visible, to be cleanly categorized, you know?
Right. But step into the world of market risk, and suddenly that x-ray machine fails us entirely. We are looking at a diagnostic landscape that is entirely murky.
Absolutely. Which brings us to our focus today. We are looking at the conflation of low volatility with low risk, specifically the hidden dangers of quiet markets.
Does a low volatility environment inherently create structural dangers for traders? Or does it merely expose pre-existing flaws in a trader's exposure and position sizing mechanics?
Right. That is the core question.
And I take the position that quiet markets actively deceive traders. They project this illusion of safety that masks distinct structural threats, like liquidity vacuums and correlation traps.
And my perspective is that volatility is simply a neutral measurement. A quiet chart is just data. The true danger lies entirely in mechanical failures of leverage and concentration by the trader, not the environment itself.
So let me lay out exactly why the illusion of safety in a low volatility environment is so dangerous. It really comes down to the sensory feedback loop the market provides.
Go on.
When you look at a quiet chart, you see small daily candles, price moves slowly, grinding up or down by fractions of a percent. The immediate visual and financial feedback suggests danger is nowhere in sight.
Sure, it looks calm.
Right. And this environment breeds a very specific position sizing trap because daily losses appear microscopic and your stop loss seems completely out of reach. Standard risk management math actually encourages you to take on larger positions.
Well, it encourages the undisciplined trader.
But it gives you false confidence. The calm environment is actively masking sudden, severe threats. Gap risk, liquidity vanishing, correlation breakdowns. These are structural dangers that strike precisely when those quiet conditions abruptly end.
I hear what you were saying.
The environment lulls you into scaling up your exposure, and the trap snaps shut when you are carrying maximum risk. Look, the calm itself is the weapon here.
I think you are giving the market a level of malicious intent it just does not possess. A quiet chart is not a weapon.
It feels like one when it traps you.
Maybe, but the danger comes strictly from how a trader builds their position. The instrument itself does not dictate your risk. Your exposure does.
Okay, explain that.
Well, imagine two different traders. One buys 10,000 slow-moving shares of a highly stable utility company. The other buys a single share of a highly volatile technology startup. The trader holding the 10,000 shares takes on far more real, quantifiable risk.
Because of the raw capital deployed.
Exactly. That is a failure of leverage and concentration on the part of the trader. It is not a consequence of the market's volatility profile. The market did not force that trader to scale up their position size.
But the market made the 10,000 shares look like a safe bet.
The trader made a mechanical error in calculating their exposure boundaries. The market measures movement. The trader alone dictates the danger.
See, you are treating the trader like a perfectly rational robot operating in a vacuum. But traders interact with their environment. Low volatility actively changes human behavior for the worse.
I disagree that the environment is to blame.
Think of it like driving on a perfectly straight, empty highway. When the road is straight and there is no traffic, the environment itself causes speed blindness. You press the accelerator because the sensory feedback tells you it is safe.
Right, but you are still pressing the pedal.
True, but you feel completely in control traveling at fatal speeds. In the market, your risk models look at the small, average true range of the asset. If a stock only moves 10 cents a day, your standard portfolio math tells you that you need to buy a massive block of shares just to generate a nominal return.
That is if you are chasing a specific return threshold.
Which everyone is. The chart looks stable, so you buy more. It works for weeks, reinforcing the belief that your strategy is bulletproof. The environment trains you to take on fatal levels of risk. You cannot separate human psychology from the market condition.
The highway analogy sounds great, but as I said,
The driver is still the one pressing the pedal. Blaming a quiet market for massive losses is like blaming the ocean for being flat right before you overloaded your boat with cargo.
But a flat ocean invites more cargo.
The calm water did not sink you. Your decision to ignore the boat's maximum capacity sank you the moment a sudden storm hit. A disciplined professional does not automatically buy more just because recent candles are small.
They don't?
No. They price the worst-case scenario into the trade. The error is failing to ask the right mechanical questions. A professional asks, how much capital do I lose if my stop is filled $2 away instead of 10 cents away?
Which rarely happens in a quiet market.
But that is an exposure issue. It has nothing to do with the recent pace of price action. If someone increases size simply because a market feels calm, they are abandoning basic risk math.
But the highway analogy only covers the trader's psychology. What happens when the highway itself suddenly runs out of pavement?
What do you mean by that?
Because that is exactly what a liquidity vacuum does in these quiet markets. We need to talk about concrete market mechanics.
Okay, let's talk mechanics.
When volatility is low, the order book thins out. Market makers, the institutions providing the bids and asks on your screen, rely on predictable models to hedge their positions. In a calm market, they make pennies on millions of transactions.
Right, they provide liquidity and collect the spread.
But the moment a sudden catalyst hits, a surprise macroeconomic announcement, or an unexpected earnings warning, their pricing models break. Their hedges become too expensive. So what do?
They pull their resting orders entirely to avoid toxic flow.
Which is exactly what they are programmed to do. They protect their own capital.
Exactly.
But look at the result for the trader. You might look at your screen 10 seconds before the announcement and see a penny-tight spread. You assume you can exit your massive position easily.
That is a dangerous assumption.
Then the news hits. The market makers step back, and the bid disappears entirely. The tight spread becomes a chasm. You try to exit, and you suffer massive slippage.
Yes, slippage is a reality of trading.
But these risks are unique to seemingly quiet markets, because the quietness masks the lack of underlying liquidity. The calm environment tricked the trader into believing the exit door was wide open, when in reality, it was a mirage.
You just outlined the exact reason why this is a trader error, not a market trap. The market maker isn't there to protect your exit.
But they give the illusion of an easy exit.
Notice how the danger you mentioned stems entirely from the trader's assumption. The trader assumed the order book would remain robust during a stress event. The core question every trader needs to ask themselves is, can I exit this volume easily during stressed conditions?
And if the market has been quiet for months, they think they can.
If the answer is no, and you still take the oversized position, you have failed at risk management. You are calling these hidden threats, but separating probability from consequence neutralizes them entirely.
How so?
By asking specific questions prior to entry, a trader turns a hidden threat into a known, managed variable. The crucial metric to apply is this: would this trade still be acceptable if volatility doubled tomorrow? If the answer is no, the trade is structurally flawed from the moment of entry.
You are assuming a level of perfect foresight that rarely exists in practice. You say we should price in the consequence, but quiet markets actively distort our ability to measure that consequence.
I disagree that they distort it. The math remains the same.
Let's look at gap risk. Imagine you are trading a stable consumer goods stock. It has been grinding higher, moving maybe 20 cents a day for 3 months.
Sure, a low beta asset.
You analyze the data and you place a stop loss 50 cents below the current price. Based on all available historical data, you are incredibly well protected. You go to sleep feeling safe.
Stop losses aren't guarantees.
Right, because then an unexpected supply chain disruption is announced overnight. The market opens the next morning $4 below your stop loss. The calm market deceived you into thinking the tight stop was sufficient. The data used to calculate the risk was perfectly accurate for the quiet environment, but entirely useless for the gap event.
But gap risk is a constant presence in any market environment. A stop loss is simply an order resting on a server. It is not a magic shield.
But the calm data makes you rely on it.
The disciplined trader prices the gap risk into the trade from the very beginning. The consequence of the gap is what destroys the account. and that consequence is purely a function of leverage and concentration.
It is a function of the unexpected move.
A sudden $4 move might be highly unlikely, but if the consequence of that move is catastrophic, the position was poorly designed. If a bad fill destroys your portfolio, the position size was mathematically incorrect for your capital base. The blame rests on the failure to stress test the extreme scenario.
Even when the stock was only moving 20 cents a day prior to the event. Let me stop you right there, because if we only size positions for the absolute worst-case overnight gap, no one would ever trade.
They would trade with appropriate size.
You would buy one share of stock. The reality of the market requires utilizing leverage to capture returns in low-volatility environments. And this brings us to correlation risk, which is where the deception of quiet markets becomes systemic.
Correlation risk is just another form of concentration.
It is far more insidious than that. A trader thinks they are being responsible. They diversify across 5 different safe, low-volatility positions in 5 different sectors.
That sounds prudent on the surface.
Right, but let's look at the mechanics of why stocks move. In a quiet market, idiosyncratic risk, the news related to individual companies, dries up. Stocks stop moving on their own individual merits.
True, the macro factors take over.
Exactly. They become entirely dependent on massive macroeconomic tides, like interest rates or currency fluctuations. You think you own 5 different boats, but you really just own the water level.
Okay, I see where you were going.
When that single macroeconomic factor turns, all 5 of those safe positions fall together. The low volatility completely masks the underlying threads connecting those assets. The trader did the math, they diversified, but the quiet environment hid the invisible correlations.
That is a very clear explanation of how passive flows operate, but I must return to the core reality of exposure. Diversification is a mechanical process.
It is, but it relies on accurate correlation data.
If a trader fails to analyze the underlying macroeconomic factors driving their positions, they are guilty of concentration risk. Holding several positions that all depend on the exact same bond yield is an exposure error.
But the calm environment makes those positions look uncorrelated on a daily basis.
It has nothing to do with the size of the daily candles. A calm position becomes dangerous when it represents too much of your account. Whether that concentration is in one technology stock or 5 correlated utility stocks, the mechanical failure is identical. The trader failed to map their true exposure.
But the daily candles dictate the leverage. The smaller the price moves, the more leverage a trader feels compelled to use to generate a return.
Temptation, again, not compulsion.
If an asset moves 5% a day, you do not need margin. If it moves 0.5%, the temptation to utilize portfolio margin systems becomes overwhelming, and those margin systems actually require less capital for low-volatility assets.
Which is a feature of the margin rules, not the market itself.
But it structurally encourages the trader to leverage up. Small price moves create the conditions that lead to excessive leverage, which then creates large account losses when the environment changes. You cannot divorce the exposure from the environment that influences it.
As I said before, temptation is not compulsion. A professional must separate the desire for a return from the mathematical boundaries of ruin. True risk depends on exposure, leverage, liquidity constraints, concentration, and catalysts.
And recent price movement dictates how a trader perceives all of those.
Notice that recent price movement is not on that list of risk determinants. If a trader utilizes excessive margin because the market has been quiet, they are violating the core principle that risk depends on the size of the loss when assumptions fail. The instrument does not define the risk by itself.
But a quiet market is...
A quiet market is just an environment with a low probability of immediate large moves. The danger is the exposure.
That brings us to the mechanics of historical volatility. This is the core of why quiet markets are actively deceptive. Historical volatility compresses right before a major expansion.
Yes, compression phases are well documented.
It is a compression phase. Look at the order book during these times. Sellers lower their asking prices, buyers raise their bids, the range tightens, the daily candles get smaller.
And the volume usually drops.
Right, and the trader naturally feels more secure because the fluctuations are tiny. But structurally, that compression is storing energy. Consensus is reached temporarily, but sideline capital is building up.
I don't disagree with the mechanics of a breakout. When a catalyst finally hits and that consensus breaks, the release of pent-up supplier demand is violent. The calm market is not just a neutral setting, it is the physical setup for the explosion. Therefore, the measurement of recent volatility is actually a contrarian indicator of danger.
Compression and expansion are standard market cycles. They only damage the trader who bases their survival on the continuation of the calm.
Which most traders do.
True. Risk management is structuring the trade so the inevitable expansion does not ruin the account. The measurement of recent volatility is completely irrelevant compared to the metrics of leverage, liquidity, and potential loss.
It is not irrelevant if it sets the trap.
If you buy an oversized block of shares during a compression phase because you think the calm will last, you are making a prediction. Risk management is the exact opposite of prediction. It is exposure management.
I see why you emphasize exposure management, but you're still treating the trader as if they operate entirely outside the context of market cycles.
They should strive to.
But the visual of a quiet chart and the reality of small daily fluctuations interact with human psychology. Even a disciplined trader can be lured into the position sizing trap because the math of the immediate past justifies it.
The immediate past is a dangerous metric.
If their strategy has generated steady returns for 12 weeks in a quiet environment, that reinforces the belief that the strategy is safe. And then one sharp structural expansion wipes out all those small gains.
A classic tail risk scenario.
Exactly. The calm conditions do not guarantee that calm conditions will continue, but they absolutely convince the human brain that they will.
Which is exactly why we must separate probability from consequence. The human brain struggles immensely with probability. We think because a massive drop has not happened recently, it will not happen tomorrow.
Exactly. The environment deceives us.
But the math of consequence is absolute. Good risk management is not about predicting every shock. You cannot predict the exact moment a compression phase ends or when a liquidity vacuum will strike.
No, you really can't.
What you can do is ensure that no single shock can remove you from the game. You separate probability from consequence. The sudden volatility expansion might be highly unlikely tomorrow, but the consequence of being over-leveraged when it happens is catastrophic.
Right.
So you size the position based on the catastrophic consequence, not the low probability. You must ask, what happens to my account when normal conditions stop?
Well, that is exactly where our perspectives converge. We both agree that market participants must look beyond how much an asset normally moves,
Yes, they absolutely have to.
and instead focus entirely on what happens when normal conditions stop. However, I maintain that the environment itself plays a deceptive role. Small daily candles and slow price movement breed a psychological illusion of safety.
They certainly can.
They tempt traders into the position sizing trap, leading them to hold larger positions than the setup deserves. Furthermore, this calm environment actively masks severe structural threats like gap risk, correlation breakdowns, and liquidity vacuums that strike precisely when those normal conditions abruptly end.
And I maintain that while the psychological temptation is very real, the ultimate danger comes strictly from how a trader builds their position. The instrument itself does not define the risk, exposure does.
Right.
A trader buying an oversized block of slow-moving shares takes on more real risk than one buying a single volatile share. That is a failure of leverage, discipline, and concentration. It is not a consequence of the market's volatility profile.
I hear you.
True risk is defined entirely by exposure, leverage, liquidity constraints, and the catastrophic consequence of failing assumptions, regardless of how fast or slow the asset moves.
We will leave the conclusion open for the listener to decide whether the market environment or the trader's structural mechanics bear the primary responsibility for risk. Evaluating your own portfolio for hidden correlation and leverage risks offers a highly practical next step for everyone listening.
It is a vital exercise for any market participant to perform regularly.
Indeed. So the next time you look at that perfectly clean X-ray, that perfectly quiet chart, and you feel that immediate sense of comfort, you have to ask yourself, are you actually safe, or is the machine just failing to show you the fractures waiting beneath the surface?